If you were born anywhere between the 1940s and the 1960s, I need you to pay close attention to this video because what I'm about to walk you through affects your tax return, your retirement account, and in some cases, how much of your Social Security check you actually get to keep. The IRS rolled out updated rules in 2026 that most people in this age group have no idea about. And I get it, nobody wakes up excited to read IRS updates. But here's the thing, some of these changes work in your favor in a big way. There's a new deduction worth up to $6,000 per person that most seniors are either missing entirely or claiming wrong. There are new audit triggers that are catching retirees off guard, not because they're doing anything dishonest, but because the rules changed and nobody sent them a memo. And there are RMD rules that are sending people straight to a 25% penalty without any warning. So that's what today is about. I'm going to walk you through the 5 most important IRS updates affecting people born in the 1940s, 50s, and 60s right now, in plain language, with exactly what you need to do about each one. I'm Marcus Grave, and if you're new here, this is what this channel does. We take the tax and Social Security updates that affect retirees and break them down into what they actually mean for your situation. No jargon, no fluff, just what you need to know. Let's get into it. All right, let's start with the good news. There is a brand new deduction available right now specifically for people 65 and older, and it is one of the most significant tax breaks this age group has seen in decades. Here's where it comes from. The One Big Beautiful Bill Act, signed into law in 2025, created what the IRS is calling the Senior Bonus Deduction. Starting with your 2025 tax return, the one you're filing right now or just filed, if you are 65 or older, you can claim an additional $6,000 deduction on top of your regular standard deduction. If you're married and both spouses are 65 or older, that's $12,000 in additional deductions. Now here's where I want to slow down and be really clear, because there's a lot of misinformation floating around about this. You may have seen headlines saying something like, Social Security is now tax-free, or Trump's bill eliminated taxes on Social Security. I understand why people believed that. The headlines were everywhere. But that is not what this deduction does. Social Security is not automatically tax-free. The deduction reduces your taxable income, which for many people has the effect of making their Social Security untaxable. But it depends entirely on your specific income situation. Here's how to think about it. The IRS uses something called combined income to decide whether your Social Security benefits get taxed. That number is your regular income plus any tax-exempt interest plus half of your annual Social Security benefits. If that combined number stays below $25,000 for a single person or $32,000 for a married couple, then none of your Social Security is taxed. The new $6,000 deduction helps reduce your taxable income, which for people near those thresholds can push them below the line. So who does this really help? According to the White House Council of Economic Advisors, with this deduction in place, about 88% of seniors should owe zero federal tax on their Social Security. That's a big number, but that 88% only becomes reality if you actually claim the deduction correctly. And here's where it's going wrong for people. There are 2 mistakes I'm seeing over and over again right now. Mistake number 1, people are just writing $6,000 on their return without checking whether they're fully eligible. The deduction phases out if your income gets too high. Specifically, it starts reducing at $75,000 of modified adjusted gross income for a single filer and $150,000 for a married couple. For every $1,000 above those thresholds, you lose $60 of the deduction. By the time a single filer hits $175,000, the deduction is gone completely. So if you're near those numbers, you need to actually calculate your specific deduction rather than just claiming the full $6,000. Mistake number 2. Assuming the deduction changes the combined income formula for Social Security. It doesn't. The combined income formula uses your adjusted gross income, not your taxable income after deductions. So even with the $6,000 deduction applied, your combined income number might still be above the Social Security threshold. You have to run both calculations separately. I know that sounds like a lot of moving parts, but here's the simple version. Claim the deduction, then separately check whether your combined income, using the formula I just described, puts any of your Social Security in taxable territory. If yes, there are strategies to address that, which I'll get to later in this video. One more critical thing about this deduction, it expires after 2028. This isn't permanent. You have 4 tax years to use it, 2025, 2026, 2027, 2028. Every year you don't claim it correctly is a year you won't get back. Okay, now let me talk about something that nobody likes to think about: audits. And before you click off, hear me out, because this section is actually pretty reassuring once you understand what's really going on. First, the realistic context. The IRS audits less than 1% of individual tax returns. For retirees specifically, the rate is even lower. Your returns tend to be simpler than, say, a small business owner's. So statistically, the odds are very much in your favor. But, and this is important, the IRS has deployed over 125 artificial intelligence and machine learning models in 2026, up from 54 just 2 years ago, specifically to catch mismatches and inconsistencies automatically. This means mistakes that might have slipped through before are now getting flagged far more quickly. And the triggers hitting retirees hardest right now are not things people are doing intentionally. They're honest errors rooted in rule changes that nobody adequately explained. So let me walk you through the specific ones to watch for. Trigger 1, RMD mismatches. This is the big one. If you're 73 or older, you are required to take a minimum distribution from your traditional IRA or 401k every year. The IRS knows what your account balances were because financial institutions report that information directly to them via a form called Form 5498. So when you file your return, the IRS is already comparing what you withdrew to what they believe you should have withdrawn. Any significant discrepancy flags your return automatically. The penalty for a missed or insufficient RMD is 25% of the shortfall. That's on top of the income tax you still owe on the distribution. If you catch the mistake quickly and correct it, the penalty can drop to 10%. And if it was a genuine, reasonable error, it can sometimes be waived entirely. But you have to proactively address it, not wait for the IRS to find you. Here's something that's tripping people up specifically in 2026. The RMD age has changed under the Secure 2.0 Act. If you were born in 1951 or later, your RMD age is 73, not 72. But if you've been operating under old information and thought your first RMD year was different from what it actually is, that's an easy mistake to make with expensive consequences. Trigger 2. Misreporting the new $6,000 senior deduction. Remember what I said earlier about not just writing $6,000 on your return? Here's why that matters for audits specifically. The IRS computers are looking for the new deduction to be claimed on a specific schedule and with a specific phase-out calculation applied if your income exceeds the threshold. If you claimed the full $6,000 at an income level where you should have received a reduced amount, that mismatch between your income and your claimed deduction is an automatic flag. The fix is simple. Make sure the deduction is calculated correctly based on your actual MAGI. Trigger 3. 1,099 mismatches. Every form they sent you, they also sent to the IRS. This one is so simple, but it catches people every year. Every 1099 you receive, whether it's a 1099-R for your retirement distributions, a 1099-SSA for your Social Security, a 1099-INT for bank interest, a 1099-DIV for dividends, the IRS already has that same information from the financial institution that sent it to you. Their computers automatically compare what's on those forms to what you reported. Any mismatch, even a small one, triggers at minimum a notice. The rule here is straightforward. If you got a form in the mail, report everything on it. Don't leave anything out because it seems small or because you think maybe it won't matter. It will matter because the IRS already has the number. Trigger 4. Side income from consulting, freelancing, or gig work, reported wrong. A lot of retirees have picked up part-time work to supplement fixed incomes. Consulting, tutoring, selling things online, freelance projects. That's totally fine and the income is taxable, but it has to be reported correctly. If you received a 1099-NEC for that work, it needs to go on Schedule C as business income, not on the wages line of your 1040. Putting it on the wrong line is a mismatch that flags your return, and the self-employment tax rate on this income, 15.3%, often surprises people who aren't used to having taxes withheld from that kind of work. Trigger 5. Paying a caregiver or household helper without filing Schedule H. This one is very specific, but affects more retirees than you'd think. If you paid someone to help around your house, a caregiver, a cleaning person, anyone, more than $3,000 in a year, the IRS classifies you as a household employer, and you're required to attach Schedule H to your return and pay what's called the nanny tax. Here's the thing that makes this particularly easy to get caught on. If your caregiver ever files for unemployment and lists you as their employer, The state unemployment system reports that to the IRS. At that point, if you didn't file Schedule H, the discrepancy surfaces automatically. The amount involved is usually manageable, but the audit process to resolve it is not. Let me spend a few minutes here because this is the area where I see the most confusion, and the confusion is understandable given how much conflicting information is out there. The fundamental structure of how Social Security is taxed at the federal level has not changed in 2026. The thresholds are still $25,000 for a single filer and $32,000 for married filing jointly. Cross those thresholds and up to 50% of your benefits can be taxable. Cross $34,000 single or $44,000 married, and up to 85% can be taxable. These numbers haven't moved since 1984, which is a whole separate problem I'll come back to in a second. What did change is the state picture. As of 2026, West Virginia has fully eliminated its state tax on Social Security benefits. 2025 was the last year they partially taxed them. That's great news for West Virginia residents. It brings the total number of states that tax Social Security down to 9. Colorado, Connecticut, Minnesota, Montana, New Mexico, Rhode Island, Utah, Vermont, and a couple of others. And most of those offer income-based exemptions that significantly reduce or eliminate the tax for moderate income retirees. Now back to those federal thresholds not moving since 1984. I want you to really sit with that for a second. In 1984, the $25,000 threshold for a single filer was meaningful protection for most retirees. 40 plus years of inflation and COLA increases later, that same $25,000 threshold is capturing a dramatically larger percentage of retirees than it was ever designed to. This is why the new $6,000 senior deduction matters so much as a practical matter. It's not a perfect fix for a threshold structure that hasn't kept up with inflation, but for the years it's available, it's real relief for a lot of people. Here's the practical takeaway. If you're a single filer and your total income, including half of your Social Security, is getting anywhere close to $25,000, you want to be paying attention to that number every year. The same goes for the $32,000 married threshold, because once you cross it, even a small amount above the line can make a portion of your Social Security taxable, and the amount taxable increases as your income rises. This is the part I really want you to take notes on, because this is where things move from just understanding the rules to actually doing something with them. Strategy 1. Roth IRA withdrawals don't count toward combined income. This is one of those facts that most retirees either don't know or knew at some point and forgot. When you take money out of a Roth IRA, it does not show up in your adjusted gross income. It is not counted in the combined income formula that determines Social Security taxation. It is effectively invisible to the IRS from a Social Security taxation standpoint. If you have both traditional IRA money and Roth money, and you need to pull from your retirement accounts, pulling from the Roth keeps your combined income lower and can protect more of your Social Security from being taxed. Strategy 2. Qualified charitable distributions are one of the best moves available if you're 70 and a half or older. If you're taking RMDs and you're also charitably inclined, this is genuinely one of the most efficient tax strategies available to you. A qualified charitable distribution, QCD, lets you send money directly from your IRA to a qualifying charity. That distribution satisfies your RMD without ever touching your taxable income. It doesn't go through your AGI, it doesn't push your combined income up. You satisfy your required distribution, you make your charitable gift, and you keep your taxable income lower than if you'd taken the RMD and then written a separate check to the charity. The annual QCD limit is $105,000 per person in 2026. Strategy 3. Watch what you're doing with IRA distributions and capital gains in the same year. Here's something that trips people up. If you take a large IRA distribution in the same year you also realize significant capital gains from selling a home, selling investments, whatever it might be, those two income events can stack on top of each other and push your combined income well above the Social Security taxation threshold in a way that neither event alone might have. If you have flexibility in the timing of any of these events, it's worth thinking about whether spreading them across 2 tax years changes your outcome meaningfully. Strategy 4. Free tax help is available and most seniors don't use it. This one is simple but underused. The IRS runs 2 programs, VITA, Volunteer Income Tax Assistance, and TCE, Tax Counseling for the Elderly, that provide free tax preparation specifically for people 60 and older. AARP Foundation Tax-Aide is another free resource with thousands of locations across the country. These programs are staffed by trained preparers who know the rules for retirees, including the new senior deduction, RMD reporting, and Social Security taxation. If you're filing your own return and you're not entirely confident you've captured everything correctly, these resources are worth using. Call 800-906-9887 to find the nearest VITA or TCE site, or go to aarp.org/taxaide for the tax-aide locator. All right, let me bring this together quickly before I let you go. If you were born in the 1940s, 50s, or 60s, here's what's actually new and important right now. 1. There's a $6,000 senior deduction available for 2025 through 2028. Claim it, calculate it correctly based on your income, and understand what it does and doesn't do for your Social Security tax situation. 2. The IRS has significantly upgraded how it catches discrepancies, especially around RMDs and 1099 mismatches. Every form you received, the IRS already has. Report everything. 3. If you're 73 or older and you haven't confirmed your RMD amount for this year, do that now. The penalty for getting it wrong is steep, and the IRS is specifically checking this. 4. Roth withdrawals and QCDs are two legitimate tools that can reduce how much of your Social Security gets taxed. If you haven't thought about either of these, they're worth understanding before your next major financial decision. And 5. If any of this feels overwhelming, free help is available. VITA, TCE, and AARP Tax-Aide exist specifically for people in your situation, and they're staffed by people who know these rules. If someone in your life, a parent, a sibling, a neighbor, is in this birth year range and managing their own taxes without any of this information, please send them this video. The rules have changed enough in the last year that same as last year is not a safe approach anymore. Subscribe to this channel. Every year, the IRS updates something that matters to people in retirement, and every year this channel translates it into plain language before it catches you off guard. I'll see you in the next one.